Welcome to RankLens. Today we count down the top 10 biggest stock market crashes by peak-to-trough drop. The stock market has crashed before, many times. But some crashes are more catastrophic than others. The ones you're about to see? They redefined financial disaster, each one erasing trillions in wealth, toppling governments, or reshaping the rules of capitalism itself. We're counting down the 10 biggest stock market crashes in history, measured by peak-to-trough percentage loss. These aren't small dips. These are the moments when fortunes vanish in days, markets freeze, entire economies reboot. So buckle up. We're going deep into financial carnage, starting at number 10. At number 10, Black Monday, October 19, 1987, a crash of 26.8%. On that single day, the Dow Jones fell more than 22%, the steepest one-day drop in history up to that point. Automated portfolio insurance programs, which were supposed to protect investors, actually amplified the sell-off into a historic freefall. Computer algorithms told funds to sell whenever prices dropped, creating a vicious feedback loop of panic selling that fed on itself. Billions of dollars evaporated by lunchtime. But here's what came next. Regulators didn't panic or freeze. They introduced circuit breakers, automatic trading halts that kick in whenever markets drop past certain thresholds. That single safeguard has prevented dozens of mini-crashes from becoming full-blown disasters in the decades since. At number 9, the COVID-19 crash of 2020, a plunge of 33.9%. When the pandemic forced economies to shut down in March 2020, the stock market didn't ease downward. It collapsed. The bear market took just 33 days to complete, the fastest on record. Weeks, not months or years. Investors watched trillions vanish in real time, triggered by lockdowns, unemployment spikes, and the sheer uncertainty of what came next. But Congress acted fast. Within weeks, lawmakers passed the $2 trillion CARES Act, pumping emergency money into businesses, workers, and stimulus payments. It was historic government intervention, and it worked. The S&P 500 fully recovered its pre-crash level by August 2020, a stunning V-shaped recovery that turned a catastrophic crash into the fastest bear market and the fastest recovery in modern history. At number 8, the 1968 to 1970 bear market, a 35.4% decline. Vietnam War spending fueled inflation that steadily eroded corporate profits throughout the late 1960s. Investors watched earnings shrink as prices rose simultaneously, a brutal combination that squeezed profit margins. Then came the corporate collapse. Penn Central Railroad, once a blue-chip titan, filed the largest U.S. bankruptcy to that date in 1970. One of the nation's largest railroads, bankrupt. The shock rippled through markets nationwide. The crisis ran so deep that just 3 years later, in 1973, another significant market decline would occur. But in 1970, investors were simply trying to survive the present catastrophe, not thinking about future collapses. At number 7, the World War II crash of 1939 to 1942, a decline of roughly 37.5%. Unlike most crashes, this one occurred alongside something unusual. The market reached its wartime low in April 1942, months after Pearl Harbor. Investors feared prolonged conflict, debt, and economic disruption. But here's where this crash diverges from all the others. Even as the market fell, the economy didn't collapse. War production eventually drove a strong economic recovery before the war ended. Unemployment plummeted. Factories ran 24/7. The U.S. was mobilized. And despite the stock market's pessimism, people had jobs and paychecks. The crash reflected investor fear, not the underlying economic reality. By 1945, when the war ended, the recovery was already in full swing. At number 6, the 1973 to 1974 oil crisis and stagflation, a brutal 48.2% decline. Arab OPEC members cut oil exports to the United States in October 1973, retaliating for U.S. support of Israel in the Yom Kippur War. Oil prices roughly quadrupled. Energy that had been cheap and plentiful became scarce and expensive overnight. Companies couldn't raise prices fast enough to cover costs. The result? Stagflation. Stagnant growth paired with rapid inflation simultaneously. Your paycheck bought less. Your employer couldn't afford raises. Profits evaporated. Investors had never seen this economic monster before. Traditional investments offered no protection. The stock market cratered nearly 50%. The crisis didn't resolve quickly. It took years of painful adjustments, interest rate hikes, and economic restructuring before stagflation finally broke. At number 5, the Panic of 1907, a crash of roughly 50%. The crisis began when someone tried to corner United Copper Company stock, buy up enough shares to manipulate the price. The scheme failed spectacularly, bankrupting the conspirators and triggering a wave of panic selling. Banks and trusts collapsed. But then something remarkable happened. J.P. Morgan, the most powerful banker in America, personally organized emergency loans. He pledged his own fortune to stabilize the financial system. Morgan's intervention prevented a complete financial meltdown and saved the banking system single-handedly. That act of desperation changed history. Congress realized the U.S. needed a permanent solution, not a single banker's heroics. The Panic of 1907 directly prompted Congress to create the Federal Reserve in 1913, the central bank that still manages U.S. monetary policy today. At number 4, the 1937 to 1938 Roosevelt Recession, a crash of 54.5%. President Franklin D. Roosevelt cut New Deal spending in 1937, believing the Depression was finally beaten. It was a catastrophic miscalculation. The economy instantly relapsed. Unemployment spiked. The Federal Reserve tightened credit further by sharply raising bank reserve requirements, draining liquidity from the system. The market plummeted 54.5%, wiping out much of the recovery that had painstakingly accumulated since 1929. What made this crash uniquely cruel? It struck before the U.S. SUTs had fully escaped the 1929 Depression. Americans who had suffered through 8 years of economic pain faced a fresh collapse. The Roosevelt Recession proved you can't simply declare recovery and exit stimulus. The market demanded proof. Conditions taught policymakers a hard lesson about premature austerity. At number 3, the Great Recession and Financial Crisis of 2007 to 2009, a plunge of 56.8%. This crash wasn't triggered by war, oil, or policy mistakes. It was triggered by fraud and recklessness at the heart of finance. Banks had packaged risky U.S. mortgage-backed securities and sold them worldwide as safe investments. When housing prices collapsed, the entire pyramid unraveled. Then came the moment that froze the world: Lehman Brothers bankruptcy on September 15, 2008. A historic investment bank simply evaporated. Global credit markets froze instantly. Banks stopped trusting each other. Lending dried up. The panic spread globally. Congress authorized a $700 billion bailout package called TARP to stabilize the banking system. It took years of stimulus, bailouts, and policy intervention to prevent a second Great Depression. The financial system itself nearly broke. At number 2, the dot-com bust of 2000 to 2002, a catastrophic 76.8% decline. The Nasdaq Composite peaked in March 2000, then didn't recover until 2015. 15 years. Not a single decade or two, nearly a generation waiting for the market to climb back. This was the era of irrational exuberance. Companies with no profits, no business model, just a .com domain name and investor hype. Hundreds of internet companies went bankrupt after burning through billions in venture capital. Pets.com, Webvan, e-toys, symbols of excess that crashed hard. Young entrepreneurs who'd become paper millionaires lost everything. Investors who'd bet their retirement on tech were wiped out. The crash taught a bitter lesson. Growth and hype aren't the same as fundamentals. The damage was so severe that tech investor sentiment stayed cautious for years. At number 1, the Wall Street crash and the Great Depression of 1929 to 1932. A staggering 89.2% decline. Black Tuesday, October 29, 1929, saw panic selling erase billions of dollars in hours. Investors who believed stocks only went up watched their fortunes vanish. The Dow Jones did not recover its 1929 peak until 1954, a full 25 years of waiting. The crash triggered the Great Depression, the worst economic downturn in modern history. Unemployment reached 25%. Banks failed by the thousands. Families lost homes, farms, savings. Suicide spiked. Red lines wrapped around blocks. The collapse was so severe, it redefined how governments respond to crises. It's why we have the SEC, circuit breakers, FDIC insurance, unemployment benefits, all born from the trauma of 1929. One day of panic spiraled into a decade of suffering that shaped the modern economy. These 10 crashes share a common thread. Panic compounds on itself. A drop triggers fear, which triggers more selling, which triggers deeper fear. But the list reveals something encouraging. Each crash taught the system a lesson. Black Monday led to circuit breakers. The Depression led to the SEC and FDIC. The 2008 crisis led to stricter bank regulations. The market still crashes. Fear still spreads. But we've built guardrails. What once looked like economic apocalypse now gets halted automatically. We can't prevent crashes. But we've gotten better at preventing the panic from consuming everything. And that makes all the difference. And that's the top 10 biggest stock market crashes by Peak-to-Trough drop. If you enjoyed this countdown, subscribe to RankLens for more.